Bitcoin priced in those financial conditions, which were leading by 3 months. Bitcoin's already priced it all in. So it's the worst news is in. My guess, probably up only. The chart you all care about that we came up with and every fucker in the world has copied, Global M2, 10-week lead versus Bitcoin. It's worked perfectly. I didn't expect it to work as perfectly, but it is. But basically, we're turning the corner and we should start to see higher prices. And the higher prices will come quick, and the higher prices should take us all the way back to the highs pretty soon. Not soon like in a week or two, but soon like in a couple of months. So I think what you've all had to go through is a boring...
Raoul Pal begins by emphasizing how crucial the Federal Reserve's monetary policies are in determining the state of the world economy. Raoul points out that the Fed's interest rate policies and a complicated web of tightening liquidity have caused major market changes in recent months. This has caused a stir in international markets, raising fears of a recession in the economy. In spite of these worries, Raoul Pal questions the conventional wisdom, arguing that the current state of affairs is not indicating an actual recession, but rather a temporary contraction brought on by more stringent banking conditions. Pal believes that when these circumstances start to improve, growth will pick up speed, creating the environment for fresh prospects in both conventional markets and cryptocurrencies. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you, and enjoy the video.
The Q4 tightening of financial conditions. What I have been saying for a long time now is the strength of the dollar. This is the dollar inverted in pink. The strength of the dollar after Trump got elected leads by 2 months the economy and financial conditions. As Trump was clearly going to start winning, the dollar started rallying. Oh my God, tariffs. Oh my God, whatever it was. And they started rallying the dollar, which is what happened in 2017. And what happens is it slows down global growth. The dollar is the most important input to all of global growth. And so the US Economic Surprises Index, the SESI, has been falling in line with this. Twitter, meanwhile, loses its collective shit and says, we're going into recession. It's terrible. Scott Bessent told us to. A, Scott was a Global Macro Investors subscriber for a long time. And B, it's not a recession. It is a weak patch in data driven by financial conditions that tightened last quarter. If you look at it going forwards, on a forwards basis, it's been easing fast. So we will see the economy weak this quarter, and then it will start to strengthen from a weaker base. This is not a recession. Don't be ridiculous. This is what happened last time Trump got elected in 2017. Exactly the same reaction by financial markets and exactly the same outcome. Economic data weakened. The DXY had strengthened. Then it began to weaken and economic data followed it. And we got a big boom. And we will see very similar. The dollar drives things like the ISM survey, or this is the services PMI. Services PMI was weak. Everyone's like, we're going into recession. The services PMI is weak. We're all... Really, all it's doing is following the dollar. And the dollar is leading and says it will bounce. So it will bounce. And then crypto. Here's Bitcoin. 3 month on 3 month just reflects these financial conditions and the economic surprises. So the economy is weaker. Financial conditions were strong in the past. And Bitcoin has already priced in the entire thing. So the damage has been done. Okay, what's the good news in all of this? The good news is the financial conditions index, which is the dollar, rates, and oil, is rebounding like crazy. Strong conditions lay ahead. The economic surprises index is not finished going down yet. It will go down a bit further. Maybe the Fed will be able to cut in April or March. No, it's March now. April or May, whatever it is. Maybe they'll be able to sneak in a couple of cuts. If we see the trueflation index, inflation has been falling off a cliff. I think the Fed get cover to cut, which is what they want because they need to roll the debt. The everything code, if you haven't seen it, A, ask the Raoul bot about it. B, watch the videos on it. They need to get rates down so they can roll the debt at roughly around trend rate of GDP growth. So they need to get interest rates down to 3% or lower. Guess what? The Fed today, where do they think interest rates will be? 3%. Where do they think economic growth will be? Around 3%. I've been saying this forever. This is the entire game. That's what they're trying to do. Economic surprises should be weaker. Then we're going to rebound on the back end. The next part of the year is going to be very strong. 2017, those of you remember, was an amazing year. And I think we'll see something very similar. Bitcoin priced in those financial conditions, which were leading by 3 months. Bitcoin's already priced it all in. So it's the worst news is in. My guess, probably up only. The chart you all care about that we came up with and every fucker in the world has copied, Global M2, 10-week lead versus Bitcoin. It's worked perfectly. I didn't expect it to be work as perfectly, but it is. But basically, we're turning the corner and we should start to see higher prices. And the higher prices will come quick, and the higher prices should take us all the way back to the highs pretty soon. Not soon like in a week or two, but soon like in a couple of months. So I think what you've all had to go through is a boring sideways consolidation pattern with a slight down bias. Your alts have been nuked, but nothing out of the ordinary. We saw this in 2017. We've seen it now, and we are very, very close to the turnaround. So patience is all I keep asking for. Stop being so dramatic. It's funny. It's actually boring. It's like you do not get 150% returns a year from an asset without drawdowns. You will have to get used to this. You have to stop worrying at this point in the cycle. We peaked in the cycle earlier in 2021, and we peaked because the business cycle had peaked. This time, the ISM is still low. And so we barely started the cycle. So I know we all say it's so early, nothing's really happened yet. It hasn't. We had phase one of the banana zone, which was the breakout of that consolidation range. This is the consolidation phase two. Then we'll get into the much more important banana zone phase two. It is all coming.
Raoul Pal thinks that despite persistent concerns and volatility, technology companies will remain at the top of the market. Due in great part to liquidity, the NASDAQ has maintained a consistent long-term upward trend. Although some value investors complain about the dominance of large tech companies, the truth is that these businesses continue to be very successful and drive innovation. Raoul also stresses the significance of examining what he refers to as total global liquidity, a more comprehensive indicator of market liquidity. This covers net liquidity and the M2 money supply in all of the main economies. He contends that, as it offers a more comprehensive view of international money flows, this is the most effective method for comprehending macro trends. He said that investors should take a more holistic approach to liquidity and go beyond conventional indicators like the Federal Reserve's balance sheet. Now, let's dive back and hear what he has to say.
Bitcoin, 14-day RSI, double bottom oversold. Okay, every time that happens, goes up. Sometimes it has this sideways consolidation period, then goes up. Will we have more sideways consolidation? This chart's maybe out of date by a week. For sure. Will it go up? For sure. Are we anywhere near a top? Here's our GMI Cycle Finder top that we use for exponential age asset management. XPAM, my digital asset fund management business. It's a fund of crypto hedge funds. We use this as one of the key inputs into what we're doing and how we allocate to funds. We're nowhere near. NASDAQ, let's talk about equities. You guys are nervous Nellies. This is like one of the most bearish ever readings in the history of the NASDAQ. Oh my God, Trump and Scott Bessent and tariffs, and they're all going to make us die. And you guys, stop. You are all way too bearish. The percentage of stocks trading with a RSI of less than 30 is almost record territory. And guess what? Global M2, because the everything code drives everything, drives NASDAQ too. And you guys trying to sell the NASDAQ here are selling something that is perfectly priced for liquidity. And we've had these liquidity air pockets in the past. Liquidity air pocket is when liquidity is not rising, NASDAQ overshoots, it recorrects, comes back down to trend, and then follows liquidity. Remember, NASDAQ has a 97.5% correlation to global total liquidity, which is the index that we use on a broader basis. 97.5%. Bitcoin has an 89% correlation with global liquidity. Global liquidity, I wrote about this in GMI, and there's probably not much time to talk about it now, but is my preferred measure these days. If we go back to the early phase of the Everything Code, the balance sheet was the main thing. After the balance sheet use, we started using Fed net liquidity. Once people understood that the balance sheet was printing of money and debasement, they started moving to Fed net liquidity. Now, all of FinTwit understands Fed net liquidity, as does crypto Twitter. And so they're looking at the TGA and the reverse repo and all of this stuff. Meanwhile, the game has moved. The game is always moving, my friends. The game has moved to total liquidity. In the US and everywhere around the world, total liquidity includes M2. It includes net liquidity at every single major economy level, net liquidity, plus M2. And M2's largest driver is the dollar. That is what they're now doing, which means that they're pushing the monetary policy onto the balance sheet of the banks themselves. So total global liquidity is the big one. M2, very useful number because it's a large part of it. Okay, NASDAQ and financial conditions, way overshot. Financial conditions are going higher with a 6-month lead. NASDAQ, undershot. I would not be surprised if it bounces. NASDAQ, all of you, there's so many people on Twitter who just hate technology. They hate the fact that the number goes up over the time. They hate the fact that there's a bunch of large companies who make money. They want it to be about small companies. They want it to be about value investing. It ain't so. This is the largest observable trend of our lifetimes, is the log regression channel in the NASDAQ. Get over it. We're here to make money, not be a justice warrior. And here we are in the sort of correction phase that we get often in the NASDAQ to drive the type of returns that we get. About 17, 18% a year returns from the NASDAQ, and you get larger returns.
Raoul Pal analyzes the state of the market, paying particular attention to global liquidity, the NASDAQ, and Bitcoin. He notes that an oversold double bottom, which is a pattern that usually results in price gains, has been attained by Bitcoin's 14-day RSI. Although there is a chance for short-term consolidation, he believes there is a good chance for an upward advance. After that, he turns to the NASDAQ and discusses the extremely pessimistic investor sentiment. He contends that the proportion of NASDAQ equities trading with an RSI below 30 is close to record levels, which traditionally indicates a rebound, and that many people are overreacting to bad news. Pal highlights the close relationship between market performance and global liquidity. According to him, Bitcoin has an 89% connection with global liquidity, but the NASDAQ has a 97% correlation. This implies that these assets typically follow an increase in liquidity. Additionally, he emphasizes how the measurement of liquidity has changed over time, shifting from concentrating on the Federal Reserve's balance sheet to a more all-encompassing indicator of global liquidity that takes into account the M2 money supply and net liquidity from key economies. He thinks that investors who want to successfully navigate the markets must comprehend this change. Pal also challenges the prejudice against big-cap tech stocks, stating that the reason they are still in the lead is because they are the most inventive and successful companies. He reminds investors that the NASDAQ has typically produced returns of about 17 to 18% annually. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.